hello and welcome to our webinar, Using the Right Business Entity for Your Business. Now, today we are going to be discussing a bit in what structure should you do your business, what's the disadvantages, the advantages, and what you should consider before selecting your business entity. Now, ladies and gentlemen, I just want to do a quick about us quickly. Your Money Life Coach was started because I saw a need that people needed assistance on how to manage their money better and overcome most of their obstacles they have with regards to their money. I've always wanted just to help people change their lives, and that's why Real Money Life Coach was born. There's a lot of free content that I share, and the purpose is to educate you along your journey. I'm a proud CFP professional member, so that stands for Certified Financial Planner Professional. I am also a registered business accountant in practice with the South African Institute of Business Accountants. And then I'm also a Commensa member. Now, Commensa is the professional body for coaches and mentors of South Africa. What options do you have when you need to start a business in South Africa? Well, these are the four main ones. There are alternatives, but these are the four main ones and the ones that I'll be discussing today. So, firstly, you can act as a sole proprietor, you can start a partnership, you can enter into a registration process and register a company, or you can do it via a trust. So let's first look at a sole proprietor. There is no formal registration for a sole proprietor, only required for your relevant industry. So, for example, if you are opening a restaurant chain, you will need to get your health license, your trading license, your liquor license, etc. The taxes are according to your individual tax tables. Now, I just want to discuss this briefly because some people seem to still be confused with regard to this. When you run a sole proprietor, there are certain expenses that you can claim, and SARS calls it any expense in the production of the income. So, any expense that you had to undergo in order to make the money that you made, that is deductible in terms of the tax. So, what will happen when you are a sole proprietor? Your income, if you have income from other sources, will be on your tax return. Then you will add this portion as income from a business. And the income that you will add here is generally your gross income, and then you'll list all your expenses, and only the net portion of your profit will be included into your normal tax calculation. Protection, there is no difference in legal entity between you and the sole proprietor. So if a client sues the company or the business entity, they are suing you, not anyone else. So you are 100% liable for anything that happens in your business. The cost of compliance, well, you can have a very simple DIY approach. There's no financial statements required in terms of the act. SARS may ask for your source documents, they may ask for proof of how you're keeping records. But yes, you can have a DIY approach. You don't need a professional to help you by law. I would still recommend it though, because there's a lot of things that you might not think that you can deduct from tax. And there is always the thing of wrong classification of expenses. And then SARS might disallow some of your expenses. When you are seeking for external investors and funding, this option is less attractive because they are investing in you directly. And we've seen many stories where people have just disappeared with other people's money where there's investors. So investors are less likely to invest in a sole propriety as a legal entity without some sort of security or alternative agreements. If we then look at a partnership, partnership is born the minute the partnership agreement is signed. There is no real special registration apart from, again, your industry registrations that might be compulsory. Your taxes works similar to sole proprietor. The only thing is you guys will have a partnership income statement that will then be split according to the partnership agreement. So if one partner has got 60-40, then that's how it will be entered into their income tax return. If it's 50-50, then that's how it'll be entered. So that's as simple as that. Then protection. Well, there is pretty much very little protection within a partnership. You are jointly and separately liable. So if your partner does not follow the rules of the practice or does something not quite legal or ethical, you can also be held liable for that. The cost of compliance, again, you can have a DIY approach. There's no financial statement required. However, I would recommend that you guys, as part of the partnership agreement, have some sort of agreement between the two of you or three of you, or how many of the partners there are, that you have a set agreement on how to manage the firm's money, and how the partnership will run and operate. The reason for this is point blankly, so that if there is any future disputes, you've got some sort of guideline to resolve it. I would recommend getting a professional involved to double check the numbers in case someone is cooking the books, at least, especially if you're not responsible for it. You have some sort of backup to make sure the information provided to you is the right information. Remember, ladies and gentlemen, that is unfortunately not always a guarantee. We are well aware of it. That's why accountants and tax practitioners have to be registered with professional bodies. External investors and funding, well, they'll consider it. They might insist on becoming a silent partner or being a partner in the business, and then as such, the partnership dissolves. Very less attractive for them. They can't get out very quickly. The whole business will have to fall down for them to then just extract. So it's also a less attractive route for partners and external investors to invest in your business. If we then look at a registered company, this is by far the most popular choice for South Africans. Although it's very easy to register a company, I'm not going to lie to you. You can get it done within 2 to 3 business days in South Africa. However, there is a big problem that people don't know what is required from them in terms of the Companies Act and what it actually means to be a director and what records you should keep as a company. There are various registers that you need to keep: shareholders, directors, resolutions, etc. You need to make sure that you've issued share certificates. We are dealing with companies that even on the old Companies Act, they did not do half of the things that they were supposed to do. So it is a very easy way, but the risk of non-compliance is quite big, especially if you do this yourself. So I recommend get the help of a professional. Remember, if you transgress on the Companies Act, depending on the serious nature of the offence, there is jail time or big fines involved. And besides that, if someone dies and all the registers and things are not in place, it makes it really difficult for the executor of that person's estate to dissolve that estate and distribute it to the beneficiaries. It adds a lot of complexity. So make sure you get it done and you get it done right. Taxes, it's taxed at 28%. The dividends are taxed at 20%. So the profits that you share will then be taxed at 20%. Now, ladies and gentlemen, there is quite a number of ways in which you can strategically plan your tax. So I suggest you have a discussion with your accountant or bookkeeper in that regard. Directorship, there is certain duties that a director has in terms of, not should has. There's certain duties that a director has in terms of the Companies Act. A lot of people aren't aware what they are, but it basically boils down to, if you mismanage the company, you are liable for that. And people can hold you directly liable. Directors are not shareholders by default. That's a point where most people seems to be confused. So when you register a company, you don't need to disclose the shareholders. That's why your shareholders register is very important. When you register your company, you need to disclose to CIPC the director. And one of the duties of the director is to protect the interest of the shareholder. Okay. So because 2 people are directors on a company does not automatically make them shareholders. So make sure that you've got that done. Also, make sure that you've got a shareholders agreement so that if you're directors, so let's say you've got external and internal shareholders, or the two of you are directors, but now because something happened, you decide to not be a director. Make sure that there's at least a shareholders agreement between the two of you so that if one party wants to sell out, you've got some protection. There's quite a lot that you can do to protect yourself if you do this right. Um, Shareholders are protected in the sense that the only risk they are exposed to is losing their capital. Directors can be held liable if there was mismanagement of funds in the company. So it's very important that you do understand the duties of a director again. But as such, if something does go wrong and there was no negligence or anything, it is a separate legal entity from yourself. Um, so there is some sort of protection. If the company does go in liquidation, you are protected to a point, depending if you've transgressed on the Companies Act and the duties of a director or not. Cost of compliance. Well, companies do have a higher cost of compliance. I want to stretch this point very far. You have to submit annual returns to SARS and CIPC. To SARS, we'll get into the taxes in a little while, but you cannot just register a company, continue a trade, and not let SARS know. We've had a number of companies that has come to us that is now finding themselves in very difficult positions, having to answer all sorts of questions to SARS. So please just don't register your company and think, well, nobody knows about me. Remember, the minute that your company is registered, it's the information is sent to SARS, so they do know about you. And I think in future, with the tax base being under so much pressure, it is somewhere where they will be looking. So don't just be compliant. SARS has also changed the traditional tax clearance system. So when you apply for a tax clearance now, they issue you with a PIN letter. And it allows people who've got access to that PIN letter to do real time monitoring of your SARS and tax compliance. So when you apply for a tender, they will ask you for that PIN letter. That PIN letter will then be when they assess the tender and let's say they decide, well, listen, we're going to award the tender to you, but you haven't been filing your taxes. That PIN letter will then show them immediately the day you become non-compliant. So there is a bit of a risk in it, and that's why it's very important that you partner with someone to make sure that you manage the company finances properly, especially if you are involved in tenders and where tax clearance becomes a real part of your day-to-day activities. We'll get to the annual tax obligations in a bit. Then you've got external investors and funding. A lot of people are a lot more open to investing because they can get shares from the company without being directly involved day to day into the business. That's the duties of the director and the staff. So yes, there is a lot more scope if you are looking for investors in a registered company. Now, what I also want to stretch for you guys is the difference between ordinary and preference shares. Remember, the risk that a shareholder runs is when the company liquidates. So let's say something goes wrong, the company's assets exceeds its liabilities, it's now going into liquidation. And where does the shareholders fall? Well, the shareholders fall's pretty much lost. They get whatever's left after all the debt's been paid, etc. Preference shares is more like a debt instruments for the company. They get preference in terms of when the company liquidates, and depending how they're structured, they will either be more than ordinary shares, ranked higher than ordinary shares, or they will be ranked right at the top. It all depends what the agreement and the share certificates, etc., says. Then we get to a trust. Now, this is the least attractive way to do business. You are taxed at 45% from the business, although you can distribute it to your beneficiaries via the conduit principle. But it's really a complicated way to do business and not somewhere where I'd recommend a trust. So, sole purpose is and will always be for me to make use of it for estate planning. The cost of maintaining a trust has over the years become ridiculously more expensive year after year. with the changes in regulations because of the misuse of trust to avoid paying tax. So the trust structure basically has a founder, trustees, and beneficiaries. It's governed by the trustee. So apart from the laws, the Trust Property Control Act, it's governed by whatever is in the trust deed. You can or cannot make changes to the beneficiaries. According to the trust deed, there must be at least 3 trusts to make sure that trustees to make sure that the trust is managed and organized properly. So yeah, there's quite a lot of details into a trust. Generally, you'll have a third independent trustee, which will charge you a fee for being a professional trustee on your trust. So it's really a very expensive way to do business, and it offers you no more protection than being in a registered company. What you can do if you really wanted to make sure that you protect your personal things is you can have the shares held in trust in a trust structure. But again, that's for very high net worth individuals. And even in those instances, I always look at what the cost will be on an annual basis versus the tax you'll have to pay. And should you just not take out life insurance to pay for the tax and get it over and done with? So yeah, to cut it short, that's basically the entities. I want to get to understanding the taxes to help you guys get a understanding of what it is, because people think when we talk to them about taxes that there's all these different amounts of taxes and they get very confused. Yes, there is a number of taxes. Let's start with income tax. Income tax is one type of tax that a company has to pay. And how it works is, and this works for individuals who are business owners and partners in partnerships, etc. Um, how this basically works is if um, you've got annual tax. So you've got after you've traded for 12 months or so, you now have a profit and now you are liable for tax. Now, what SARS does is they've got what they call provisional tax so that they can get tax from you during the year instead of just once when you submit your income tax return. That's called provisional tax, and that's been brought in just to help government to manage their cash flow. As you know, the heartline and the heartbeat of every single business is cash flow. So if your cash flow is in a state, then your business is basically on CPR and life support. And let's hope it's not on oxygen ventilator system right now. So if you look at the provisional tax, so you've got by the end of August and by the end of February, normally your provisional tax returns depends on your year end. Most people align their company's year end with the normal income tax year end, which is the end of February of every year. That's why I've done this slide the way that I have. So at the end of August, at the end of February, you have to pay provisional tax. Now, if you pay less than 80% of the tax that was due by the end of February, and I'm oversimplifying it, guys, it's really oversimplified. 80 or 90% of the tax that you were supposed to pay by the end of February, then SARS will charge you penalties for underestimation of provisional tax. Now, because most businesses are still busy finalizing and there might be a big deal in the pipeline and you might not know if, by the time that you submit your provisional tax at the end of February, if it will fall into the February financial year. And SARS has then therefore said, okay, we'll give you another option, which you can submit a third provisional tax, which is not compulsory. August and February is, but by the end of September, you then have an option to make a third top-up payment if you short paid. So yes, there is options. Again, discuss this with a professional so that they can guide you through what is the rules, what you should, what you shouldn't do. There are a number of rules with regards to provisional tax and the penalties and interest thereon. SARS implements those penalties and interest very quickly, even though some people might not even think they're provisional taxpayers. If you didn't pay your taxes on time and you should have been a provisional taxpayer, then you will be charged the penalties if whatever you paid was not sufficient. Okay. Assess tax, you have to submit 12 months after your financial year ends. So that's generally then by February of the following year if your year end is in February. Let's have a look at VAT. Now, VAT is a separate tax type, and when you register for VAT, you become what they call a VAT vendor. Now, a VAT vendor is basically it's exactly what it says. You collect VAT for the government. And what SARS said, well, listen, because you're doing the work for us to collect one of our taxes on behalf of us, we will then allow you to deduct certain what they call input taxes from the VAT that you need to pay over to us. So I'm going to use a very simple example. If you trade in stock, you are likely paying VAT on the stock that you are buying. And when you're a VAT vendor, you can charge 15% over and above that. Now, ladies and gentlemen, please don't charge VAT if you are not a VAT vendor. It's a criminal offense. You can end up spending up to 10 years in prison. So please be very careful before you just start charging VAT. Make sure you are registered as a VAT vendor. You'll get a tax number, a separate tax number. It's not the same as your income tax number. It's a different number and it generally starts with a 4. Okay. You'll have then to submit bi-monthly returns to SARS. So you'll say to SARS, this is my sales. This is the VAT on my sales. These are the things that I expenses in my business. If there's VAT on your rent, you can claim that. So remember, your landlord does have to be a VAT vendor. If there's VAT on your bank fees. So you can charge VAT. You can claim the VAT back on your bank fees. If you bought stationery, you can claim that back. I do want to make emphasis here. Make sure that you understand the minimum guidelines in terms of what an invoice issued to you. In other words, where you've bought something or an invoice that you've issued to a client, that you meet those minimum requirements. Okay. And at the end of the year, SARS does a VAT recon automatically when you submit your tax return. If you've got a decent accountant, they do that anyway before they prepare your financial statements, and that has to align up. So if you cheat SARS, they will know, and trust me, they always know. So if you decide to become a VAT vendor, there is a lot of compliance to it. It does add to the cost. Most small businesses, I don't recommend registering for VAT unless there's a huge benefit for you, or if your industry, some industries requires that the suppliers are VAT vendors. It is voluntary to register for VAT if you've got a turnover of more than 50,000 Rand in a 12-month period. You can register for VAT. It becomes compulsory to register for VAT where you have a turnover. In other words, your gross sales. In other words, every single cent that your business has received as income is in excess of R1,000,000 over a 12-month period. So it's not the financial year necessarily, it's over a 12-month period, and then you need to register for VAT ASAP. So make sure that you understand what is required if you are a VAT vendor and how you need to manage this on a bi-monthly basis. And most importantly, that the invoices you receive and provide to your clients meet the minimum requirements. PAYE, UIF, and SDL. Now, PAYE is not a separate tax for the company. PAYE is again just the company who is an agent on behalf of SARS collecting tax from employees. That's what PAYE is. It's pay as you earn. So you're paying tax as you earn money, and your employer collects it on your behalf. And now, at the end of the financial year, there's normally a mid-year recon that you submit to SARS. Listen, for the PAYE returns that I've submitted, that's due by the 7th of every single month. This is the workers that I had, this was the income, this was the PAYE I deducted and paid over to you. And then you've also got your annual recon. And after you've completed your annual recon is where you will issue what they call an IRP5. Now, most of you know what an IRP5 is, but do you know that an IRP5 is just basically your receipt for the tax that you've paid? So, yes, that's why you will issue the IRP5. That will then pull through to your employees' tax return, where they can then say to SARS, well, this was my income, and then claim the respective deductions for medical aid, retirement savings, etc. Then you've got UIF. Now, UIF is a bit more tricky. If you are an employer, you are required by law to register for a UIF number with the Department of Labor, UIF, or and SARS. Okay. So if most of your staff members don't earn enough to pay PAYE, you can only register with UIF. That's fine. But in most instances, most people do earn more that they do need to start monthly PAYE. You can also pay over PAYE for yourself as a director or a shareholder of the company as well, just between the two of us. But yeah, that's a whole new discussion and something totally separate. There is advantages and disadvantages to that. But let's stand still with UIF. So on your monthly PAYE return, the UIF is there. You can then declare the UIF and pay it together with your PAYE return. But you also need to submit a monthly UIF return to the Department of Labor as well. So it does become quite tedious. SDL is a skills development levy. It's used to fund the SETA. So in the insurance sector, we've got the insurance SETA, etc. Those are the training and development partners in the relevant sectors, and then they will then it's a levy, 1% levy that's added onto your payroll automatically, and this only applies to companies where their payroll is more than 500,000 rand per annum. So that is the total value of all your employees' gross earnings. So that's before deductions. If it exceeds more than 500,000 rand a year, then you definitely need to register for SDL, and that's a very simple one. You can just add that onto your PAYE return. Just make sure that you do reflect it on your employees' pay slips as well. Right, now we look at succession. So, succession basically means that if I want to sell the company or if something happens to me, how does it get transferred to other people? So, where you sell the company, if you're a sole proprietor or in a partnership or in a trust, you will, in all likelihood, sell the clients, in other words, the future income of that company or that business, and you will sell the business equipment in most instances. As a company, register company, you can sell it as a whole. It's a change of shareholders, change of directors, and it's done. So that makes a company very attractive. In terms of succession, we'll touch a bit on buy and sell, but I just want to touch a bit about on a trust, and then we'll work back to the rest. There's no transition really if you are doing business on a trust, because the beneficiaries of the trust will then just, they will still continue earning what they earned if the business is able to continue without you. Otherwise, you can sell the business, i.e., the clients and the equipment, to someone else. The money will get paid into the trust, and that will be for the benefit of the beneficiaries. In a company, you've got what we call buy and sell opportunities. Now, in short, a buy and sell is an agreement. And again, I'm oversimplifying this. You need to get professional help when you structure it, because there's a lot of tax advantages if you structure it right, especially in terms of estate duty. So, in terms of your company, there's buy and sell opportunities. And what we say about that if one of the directors or shareholders passes away, well, mostly shareholders for buy and sells, if one of the shareholders passes away, you then have the option to create a buy and sell agreement funded by life insurance, so that when one of the partners dies, the life insurance will pay out to the other partners, who can then pay the estate of the shareholder that has died, and then they can use that money for whatever purpose, and there remains control and consistency in the business. So that is in essence what a buy and sell agreement is. Now, you can have a buy and sell in a partnership. Just note that when one partner dies, the partnership effectively comes to an end. It can then be resuscitated if you want to, resected as a new partnership. So that's a new agreement between the new partners. On a sole proprietor, there is really also just the equipment and the things can be bequeathed to the beneficiaries. You can also have one-way buy and sells, and what we say by that is someone who is not part of the business, because obviously it's a um, owned by the owner. So maybe a top employee can take out the life insurance on the life of the insurer, so that if something does happen, he can pay the family for the clients and the business equipment, and then start trading in his own name or register a company or however he wishes to continue. Closing a company versus a partnership versus a trust versus a sole prop. The easiest to close is a sole proprietor, because you just simply pay all your debts, cease trading, and you are done. You can, with a partnership, just terminate the agreements after you guys have gotten to the agreement to do that. A company requires liquidation or distribution, or deregistration. So when you are looking at liquidation, it generally means that the company does not have enough money within itself to buy out the shareholders. Deregistration is, it follows a process where the value of whatever the shares is paid out to the shareholders, the company becomes null and void, and then it needs to be properly deregistered. There's a lot more complications to this. So it's a quick overview, but it is a more complex process than closing a sole proprietor. A trust also requires deregistration. That's a lot more trickier, because the trustees have to prove that it's in the best interest of the beneficiaries, that there's no more funds, etc., etc., etc. So that is a very difficult one to simply just close. Hence, another reason why I will not recommend, in 99.99995% of the situations, that people do business in a trust. So, ladies and gentlemen, that's the broad overview. You will see that there's quite a number of things that I've shared. I will do another session on how to do record keeping, and how you should structure your accounting processes within your company, and where you should bring in the help of professionals, especially if it's not your strong suit. We will do another session on that. I'm going to ask that you please support us. Sign up for our blog on our website, yourmoneylovecoach.co.za, and please follow our page on Facebook. We share some interesting information, and from time to time, you will get exclusive invites onto webinars like these. Book your first coaching session. Remember, the first coaching session that we do is complimentary, so that you can get the feel for it, see if this works for you, if it's a possibility for you to explore, and that you can make it work in your best interest. Thank you very much for joining us today. If you've got any questions, comments, or topics that you'd like us to discuss in the future, please reach out to us. You can find our contact details on our website, or you can just comment below and we will get in touch with you. Thank you very much for joining us.